Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about why a $400,000 income is not enough and how a sample budget for this income works. Let's get started. We're going to review in this video what a $400,000 income and budget look like in a metropolitan area for a family of four and why it's not really enough money to truly feel rich. So you might be thinking about how $400,000 is plenty of money to make in a year. In reality, it's not a ton of money in a big city, especially when you're talking about a family of four. I've seen similar scenarios before during my time in financial planning with varying family incomes and expenses. Budgets were often still an issue along with sometimes debt. So I wanted to highlight what a big city lifestyle costs, and you can compare it to your own lifestyle and budget based on where you live and your income. The cost of living in a big city is much higher, and even daily expenses like buying lunch on a workday averages about $10 to $15 unless you bring lunch to work every day or unless you go for the absolute cheapest options, which generally aren't as healthy. Local income taxes are higher, and usually state income taxes follow suit, also being high. Another thing to note is that higher paying jobs also tend to be in big cities, so it's a bit of a catch-22. Higher incomes generally tie back to higher taxes in states and cities that have higher taxes. And if you have kids but no longer qualify for financial aid for school and college tuition, that means additional planning and saving for education costs for college and potentially high school too, depending on the school districts in your area. And for many people married or single living in big cities, just to overcome all the income taxes or to have extra disposable income requires having a side hustle or even multiple that generate some additional income. Let's talk about what a middle class family is defined as in a major metropolitan area. My definition of a middle class family is the ability to buy a home with at least 2 to 3 bedrooms, have 1 to 2 kids comfortably, save for retirement, save for education costs for those children, drive an average car or a certified pre-owned car with a retail price at or below $30,000 given where car prices are currently in 2021, and going on a couple vacations a year. I don't think that sounds unreasonable by any means. Most couples living in big cities generally have two salaries or two W-2s, which generate earned income. Earned income is taxed at the highest rates, so as odd as it sounds, actually working for your money is the least tax efficient way to make money. The way the tax system is set up, it's beneficial to businesses to create value and profit from creating products or services for consumers or businesses, and as a result, grow and continue to create jobs. The tax system also benefits anyone who invests long term for lower tax treatment. Businesses and investors have the ability to also take tax write-offs or deductions to reduce taxable income. When you have a W-2 as your primary or only source of income, you mostly lose the ability to take the majority of beneficial tax write-offs, aside from a small handful like the child tax credit, the mortgage interest deduction, and potential deductions from investment losses to reduce your income. Businesses have the ability to write off expenses to reduce their income, similar to how investing allows for losses to reduce profits. So this budget is originally from Financial Samurai and was constructed based on real families with a $400,000 income and their actual budgets, so it should be pretty accurate for what a typical family budget should be like in any of these big cities in the US. San Francisco, LA, San Diego, New York City, Boston, DC, Miami, Honolulu, and Seattle. Let's take a closer look at net income after taxes with $400,000 of income. Between federal income taxes, FICA taxes, which are used to fund Medicare and Social Security, and your state and local income taxes, if applicable, end up bringing your tax rate to around 30 to 35%. Once you get to 400,000 in income or more, it's more than likely that you are paying around or over 100,000 in taxes each year, depending on your eligible deductions. Keep in mind the mortgage interest deduction to reduce income is now capped at $10,000 a year, so jumbo mortgages of 500,000 or higher impact big city living expenses even more. In the past, you could take out a huge mortgage of $1 million or more and deduct the full amount of interest accumulated each year to reduce your income, which had no limit and could even be as high as $20,000 to $50,000 per year. That deduction was adjusted to max out at $10,000 over the last couple of years. Also, maxing out your 401k contributions based on 2021 guidelines of $19,500 per year per person is great if you can afford to do so at any income range, but for $400,000 or more in income, it should be maxed out or close to it to increase your retirement savings and get any employer match. If this budget was more constrained, they could reduce the contribution by a bit down to whatever percentage is required to still get any full 401k match. In total, you're working with $260,000 of net income after pre-tax contributions for 401k and after taxes, tax credits, and the standard deduction. Once you have kids, there's a whole extra spectrum of budgeting and expenses to account for. Without kids in your budget and this level of income, there's almost no way you shouldn't be able to retire by age 60 or even a bit earlier if kids aren't in the picture. However, as expensive as kids can be, it can also be super rewarding to be a parent too. But the cost of kids goes far beyond feeding and clothing your children. It extends into watching them, toys and entertainment, and educating them too. At this point, there becomes a cost to have either a babysitter or for daycare if both parents work. There comes a tipping point where if one parent is not able to make substantially more than the cost of a babysitter, that one parent should be a stay-at-home parent, since the benefit and income taxes of working do not outweigh taking care of your own children. Given the budget and income in this case, daycare or a babysitter can be covered. But understand that this is something that likely isn't part of everyone's budget that has substantially less than $400,000 in income. Education costs never seem to go anywhere but up, so those costs have to be accounted for unless you manage to predetermine that your child will just go to a state university for the cheaper college tuition over the higher private college tuition costs. Here's what the tuition rates are based on what Financial Samurai compiled for one child. It is absurdly high and shocking what private school tuition costs leading up to the 4 years of college as the finale of education expenses. In big cities, lots of the school districts are not that great, though there are obviously some school districts that are outliers and some parents specifically move to the better ones for their kids. But largely, this is true, which is why parents with this income typically send their kids to private school as an alternative to public school. Daycare and preschool expenses, depending on the age of the kids you have, are not out of the ordinary. They can possibly be a little less, but it seems about right based on expensive areas. Food for 4 people at $65 a day isn't crazy, but if you also assume a fairly busy work schedule for both parents, it may also be hard to regularly go grocery shopping instead of simply ordering takeout or delivery once in a while. The 529 savings plan, assuming it's for both kids and more than just saving for college, I think this is reasonable as tuition costs even for high school or middle school keep increasing every year anyway. If you were to assume only saving for college for 2 kids, this could probably drop down to $1,000 a month instead so you don't overfund the 529 and run into tax withdrawal issues in the future. I talk about the pros and cons in my video on 529 plans, which I'll link as a pinned comment or at the end of the video for more details on how 529 plans work. The expenses related to housing are based on average real estate prices in major metropolitan areas. This budget was based on one of the big cities in California. The actual median cost of a home is not truly $2 million like in this example, but there are many parts of California and New York City where the average home price is in this range. But even if you replace this and use a slightly smaller mortgage size and assume a super low mortgage interest rate for a 30-year mortgage at 3% or even 3.5%, the amount you'd have to borrow is still relatively high. For this example, if I were to use a lower home value at around $1.6 million and a mortgage of $1 million to $1.2 million, it seems more appropriate as that covers more than just the absolute most expensive areas in big cities and could include some surrounding suburbs. Assuming borrowing $1 million at 3% for a 30-year mortgage, the monthly payments would be around $4,200 per month. Property maintenance could also be a higher expense to balance with any mortgage payments if you live in an apartment like you might in New York City. Monthly building maintenance averages about $1,500 to $2,000 per month for roughly every $1 million of home value if you assume a fairly new building with additional amenities like a gym, pool, or even a playroom for children. Life insurance for $2 million of coverage, either on a combination of $1 million on each parent or all $2 million on one parent, is pretty accurate for a total of $1,400 to $1,500 per year, depending on the age that they purchased the policy or policies. With this pricing estimate, I would think that it was purchased around the time that the first child was born, if I had to guess. That also happens to be when people tend to start thinking about life insurance when kids come into the picture anyway. Healthcare expenses are reasonable. If the cost was much lower, you'd probably end up on a high or higher deductible plan, which wouldn't cover as much for your family. Baby-related items, I think this is pretty reasonable since diapers are expensive and diaper packages generally tend to have fewer and fewer diapers these days. I'm actually surprised at the low vacation expenses. Many people with this level of income spend a lot more on vacations and travel internationally among other expensive activities. So I think in a given calendar year, $7,200 per year is reasonable since one international trip for a family of 4 or even 2 people could easily be over $10,000 if you include airfare, hotel, and food before any tourist-related sightseeing or other activities. Entertainment for 4 people, especially 2 kids, can really add up. So between this expense and the baby items line, I think it's great that they don't exceed a total of $500 per month. Maybe it could be slightly lower, but it's unlikely. The remaining expenses, like for a phone plan with data, I'm actually surprised it's not over $200 a month, especially if either of the 2 parents are on the 2-year monthly installment plans for recently getting a new phone. And with the price of smartphones being around $800 to $1,000 these days and still climbing slightly each year, the monthly bill with data could easily get pretty close to $300 per month. Clothes for 4 people I think is reasonable to assume $200 per month, but also it could be that not every month a family would spend the full $200 on clothes, even if you assume that kids can outgrow clothes fairly quickly. Okay, so let's talk about expense reduction because every budget should go through this exercise. And maybe as you've been looking at this budget, you found some places that you think could be lower. Everyone should try their best to save money to optimize your income and expenses and invest the difference to maximize your investment gains. In my opinion, there are only maybe a couple things that can be reduced after reviewing this budget. Pretty much every budget item is otherwise within a reasonable range for living in a big city for a family of 4 and can be adjusted based on lifestyle instead. So as an overall comment about the way this budget was realistically designed, I think it's pretty clean and doesn't have a lot of fluff in it. The only 2 points that I can reasonably point out are lifestyle choices rather than being clear budgeting mistakes. The first one is obviously charitable giving, which can just be cut at any given time if they needed the extra $3,000 to be reallocated to something else. The second is the expenses related to the car, depending on which city they live in. If a family were to live in any of the big California cities, then this can't be cut out. But for example, a family living in New York City, where there is decent public transportation, they might be able to cut the car payment, car insurance, and gas expenses to save a total of $8,400 per year. Even if you gave up car-related expenses, you'd still have to pay some amount for transportation, and it would be less convenient overall. Part of the $8,400 would be spent on other forms of transportation instead throughout the year, more than likely. Keep in mind that the average price of a new car is almost or around $40,000 as of 2020, with really no indication of coming back down, and a car payment of $350 per month is on the low to average side of pricing, given where car prices are currently. Overall surplus, depending on if the charity and donations are cut out, are $3,000 per year. If car-related expenses are cut, that's $8,400 per year. As for the real estate-related expenses, I think the mortgage and property taxes can come down slightly depending on the area or moving just slightly further away from the city, but not quite into the suburbs would bring these items down by probably a total of $2,000 per month combined or $24,000 per year. Realistically, if you live in a city or state that still requires having a car, you can only trim this budget by around $27,000 per year. Without the car, it opens up the range of savings. In reality, that's actually still not a lot of surplus considering a starting point of $400,000 pre-tax and $260,000 post-tax. If you wanted to dive even deeper for additional savings, the 529 savings can be cut by $500 per month if the 529 is not being used to pay for private school tuition for middle school or high school. Arguably, if you're accounting for private school tuition, the monthly savings would actually have to go up instead of being trimmed. Clothing may or may not actually be spent every single month in my opinion, So there can be some savings there in the months that no new clothes are purchased for anyone in the family. So if you were really squeezed for extra money within this particular budget, there could be an extra $500 to $700 per month that might be able to be saved. That brings the total budget to have a potential surplus based on 2 large reductions in real estate and eliminating car expenses. Largely, I agree with most of the points that are pointed out on the Financial Samurai blog, with some slight variances based on the budget cuts I mentioned. This family would still not feel rich even if all these reductions are made to this budget. So what are some other options for this family with $400,000 of income? Moving to a different location for a lower cost of living in general for even daily expenses. This would be called geo arbitrage, to take advantage of trying to maintain a similar or high income while moving somewhere that will bring your overall living expenses down. There are 2 main issues with this, and those are that your income may not actually follow you depending on where you move to, depending on the industry you work in. The second one is that you'll likely lose out on the ability to network in person and move forward with your career, and some careers just can't be done remotely yet. Leaving your friends or family behind can also be a bit tough just to save money, but it also depends on how much money you could potentially save, even if you can get past the first 2 potential issues. So for this third one on moving away from your network of colleagues, friends, and family, you'd have to calculate the tax and cost of living expense savings and figure out whether that's worth it for you and your family or not. The only other alternative for this budget, if expenses can't really be adjusted in a significant way, is to shift away from earned income and move towards unearned income to achieve lower tax rates. Whether the shift in earned versus unearned income happens, 400,000 is still not enough to truly feel rich, especially when taxes and daily expenses are the 2 biggest persistent challenges. There are only so many expenses you can cut or trim until it's just not possible anymore. If all or most of your income is earned income, you put yourself and your family in a continuous cycle of potentially being a couple paychecks from running into budget and cash flow issues, along with delaying your retirement for even longer, and in the meantime, you would dip into your savings until you find your next job and salary. Unearned income through investments or dividends are not generally subject to FICA taxes, which is part of the reason that makes it taxed less than earned income. Also, with investing, you can take advantage of long-term capital gains tax rates over being taxed at your income rate. Additionally, earned income is predictable on a W-2 through steady salaries in any given part of the year. So being able to calculate the exact amount of taxes to be paid is possible. Unearned income is usually less predictable, which can sometimes give you a time value of keeping some extra money to invest throughout the year instead of paying estimated future taxes. Estimated taxes are quarterly payments of taxes due based on the tax filer's reported earned income for the period. This is based on the previous calendar year's income typically. The people that generally are required to pay estimated taxes each quarter are business owners, day traders, and independent contractors, also known as freelancers. These types of people or business owners who have income from these types of sources do not have taxes automatically withheld from their earnings like people with a salary or W-2, where their income is steady and predictable. The main goal you should have, regardless of your income level, is to save up as much money as possible to accumulate your wealth and then grow it through various investments. If you don't find a way to do this and eventually make income passively, you may never be able to retire. Additionally, if you only focus on income, you'll have to constantly worry about taxes impacting your net income. Once you accumulate enough wealth, you won't have to worry as much about income, since income is heavily impacted by taxes. Unfortunately, to accumulate wealth quickly, a high income is required, so it ends up being a circular reference error. Let me know your thoughts on budgeting in general and this particular budget after watching this video. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.